Caledonia mining, I once saw an article not very long ago that we were one of the 5 companies that sounded like they had Scottish heritage and didn't. So our asset is in Zimbabwe. We are a 49% shareholder in the Blanket Gold Mine, which is about 200 kilometers, about 2 hours drive south of the town of Bulawayo, which is Zimbabwe's second largest city. Last year we produced about 43,000 ounces from this mine. We're on track for 50,000 ounces this year. We had a production update out this morning. Nothing unusual, so we're targeting 50,000 this year. Cash costs are pretty manageable, about $630 an ounce cash, and when you factor in sustaining capital, royalties, all of the head office costs, all of our salaries, $930 an ounce last quarter. So we're comfortable at essentially any conceivable future gold price, and we've weathered the storm in gold fairly well. We have an internally funded project to double production at the asset. I'll talk about that in more detail later because that really is the nub of the investment case. But we're doubling production to 80,000 ounces by 2021, and with that our all-in sustaining costs will reduce quite substantially down to about $750 an ounce. Like I said, that's all funded internally from cash flow and is fairly well advanced. I'll show you some pictures on how that development is progressing. We have $10 million in the bank and no debt. That was in June quarter. We closed out quarter 3 last week, and cash has gone up slightly, but that's our public number at the moment. But we are cash generating at the moment. So despite investing fairly heavily, we are not consuming that cash balance. We had about 25 million 2 years ago, and we've used some of it, but that cash is now growing again despite the investment program. And we pay a dividend, which we're quite proud of. The yield's 3.3% at the moment. It has dropped quite substantially, not because we dropped the dividend, but because the share price has risen. So it used to be yielding about 4.5 not so long ago. We have had a good run. I suppose we're not the only gold mining junior to think we're undervalued, but share price has moved ahead fairly nicely. Zimbabwe. So about 80 to 90% of the questions we get from investors, potential investors and shareholders don't relate to the quality of the asset, what we're doing, how things are going, or the business we're running. They relate to Zimbabwe. So we'd rather deal with that issue head on. I'll comment generally and say that we are quite happy operating in Zimbabwe. It's a good place to operate a gold mine. We have everything we need to operate a mine. Our mine is 6 hours drive from Harare, so anything you see on the television about Zimbabwe, any troubles, any of the riots that recently were happening in Harare, we're far away from that. The country is what we would classify as poor but peaceful, and we're quite happy operating there. And as a former analyst, used to work for a stock brokerage, our view is the money made by people in this type of forum comes from mispriced risk, and where risk is mispriced, that's where there's money to be made. We do believe risk is mispriced in Zimbabwe. I'm no doubt there'll be questions about it, but let me deal with some of those issues now. Politically, ZANU-PF's been in power since independence, so essentially since majority rule in 1980. Robert Mugabe's been the president since then. He's now 92 years old. We do find the government fairly pragmatic and pro-business, and there is a functioning administration, which for a gold mining operation is logistically a fairly simple operation to run. We're not like an iron ore mine or a coal mine where you depend on ports and railway lines and complex infrastructure. We can fit a month's production into a briefcase. I mean, we don't do that, but this is a different operation to running an iron ore, a heavy logistics intensive operation where we depend on pipelines, etc., and those type of things. Indigenization, I did mention we own 49% of the asset. Legislation in Zimbabwe requires local businesses to own 51%, local indigenous Zimbabweans to own 51% of all assets. The important way to think about this is although we only own 49% of the asset, we enjoy about 80% of the cash flows. And conceptually, that's an important way to think about it. That situation will persist until about 2021. The reason for that is that when we indigenized this business, and we sold 51% of the asset to indigenous local Zimbabweans for $30 million. Those indigenous partners are our workers, so the local mine workers. We employ 1,200 people, and there's about 4,000 people who live on the mine site. Their families live with them. The workers own 10%, so they have quite a bit of skin in the game. The local community in the town of Gwanda, which is the town in which we operate, that they own 10% of the business. The government owns 16%, and a group of Zimbabwean businessmen own 15%. All of them were loaned the money by us, essentially a vendor-financed loan, and we enjoy 80% of the cash flows from that, of their portion of the cash flow. So we get the 49% that we own, plus we get 80% of the cash flows that would otherwise flow to them until those loans are repaid. At current gold prices, we think that situation will persist until about 2021. The structure has been approved by the Zimbabwean local ministries, the Reserve Bank and the Ministry of Indigenization. It works for us, and it enabled us to invest in the project which I'll tell you about, whereas previously there was an uncertainty hanging over the business. We're the only mine in the country that is indigenized, which we think gives us, one, a tremendous amount of goodwill, and two, we think we'd be at the back of the queue if there was ever any serious political difficulty for the mining industry, because half of our mine is owned by locals. Economically, the economy is broken. I don't know how many of you are familiar, and I have a useful prop here, but this is a 100 trillion Zim dollar note. There was the economy completely collapsed. You can come and have a look at it later. I'd like it back, but you can get these on eBay, although they are running a bit slim. That was about a tenner when I got it. It was then completely worthless shortly after that. They've now dollarized the economy. On a side note, and we don't speculate in the gold price, we're quite comfortable where it is, but anyone who thinks that monetizing debt just to fund unsustainable deficits is a good thing, we've lived it. We don't think so. There was a time when we could pay the entire wage bill of this mine for $5. So I won't talk more about that. We're not economists. Infrastructure, I've already mentioned. We have adequate, reliable power. We have grid power. It's uninterrupted. It's expensive, but it's all we need to run the mine. We also have backup generators for whenever there is. We do have power cuts from time to time. But we don't get load shed as a rolling blackout structure. And there are exchange controls, but they're manageable. We announced I think our 14th quarterly dividend this morning. Monday morning, and we get our money out of the country into our shareholders' bank accounts every quarter. It's been happening for 3 or 4 years. We don't have any difficulties getting our money out. It does require some phone calls if there's large amounts. It's not seamless like in England, but the exchange controls are manageable from our perspective. This is a bit of detail about our capital structure. The only thing really to point out to your attention is 52 million shares in issue, so a fairly tight structure. We're currently capitalized about $90 million. That's come off for the last few days. Our major shareholder is a company called Allan Gray. They're a South African institution. They own 13.5%. Other institutions are below notifiable level. Management only own 1.5%. If any of you are concerned about that, we do have a long-term incentive plan which is linked to the share price. It functions exactly as a share scheme, but it is cash settled. So a very significant portion of my remuneration depends on the share price, as does my colleagues. So we do have skin in the game, but we don't dilute our shareholders for that to achieve that incentive. These are our reserves and resources. We have about 1.3 million ounces of gold. This is going to give us, so about half of that is measured and indicated, and about half of that is inferred in terms of confidence interval. This gives us about 10 years of life with the current infrastructure we have. The comments I'd make on reserves and resources are, firstly, this mine is 100 years old, and at no stage in that 100 years did it have a 100-year mine life. So there is always an element of a leap of faith from an investor's perspective. We know there's 10 years worth of gold there, and we would suggest anyone does their numbers on 10 years worth of gold, but from an upside perspective, we're very confident we'll be around for a lot longer than the next 10 years. This is a vertical ore body, so it does get prohibitively expensive and just logistically difficult to drill from depth. If you can imagine a vertical slot of gold-bearing rock getting deeper and deeper, it becomes impossible to drill that from surface. So in essence, you have to dig the tunnels to get down there before you can drill it out to the required level of confidence, before you can communicate to forums like this and the general market that you can be certain there's gold there. We have drilled out and put holes down into the ore body, and we know it continues down to below 2 kilometers. We're currently at a depth of 750 meters. So there are very good reasons to be confident that we have 10 years. We feel quite comfortable that we'll be around for at least probably the next 20 and perhaps beyond that. Our target from an exploration perspective, and you can hopefully follow this from an announcements perspective, is that we will at least replace depleted ounces over time. So we would like to keep a rolling 10-year mine life for the next decade. Beyond that, we can't predict too far into the future. This is a production profile history. There's really 3 phases. We bought this mine from Kinross in 2006. It was in pretty good nick when we got it. It was well looked after, and there was a capital expansion project that Kinross were in the process of finishing off, which essentially enabled us to very sharply increase production into a very steeply rising gold price as well. So these were very good times. This mine was throwing off huge amounts of cash. This phase 1. Into phase 2, we had production essentially plateaued. We were probably guilty of insufficient underground development. So we didn't really drill enough tunnels to get to the portions of the ore body that we needed to get to. Mines like this don't die because they run out of gold. They die because they don't invest and fix the roof when the sun is shining and make sure that you've got enough underground infrastructure to get to the places you need to get to. We had that led to a decline in grade, and we weren't able to compensate that with volume from the underground infrastructure. This was under the previous management team. The previous chief executive has left us, and we have a new operations director and new chief executive. And this is now the investment to double production, which I'll get to in the next few pages. But you can see we're starting to reap the benefits of that investment now, and this is our future planned production increase. So this investment program essentially has 3 key components. First of all, to remedy the underground infrastructure development, digging enough tunnels to make sure you can get to the rock when you need to get to it, so that if you do find a section of low grade, you can compensate for that. So that's the underground handling, essentially digging loops and tunnels and making sure that our trains and tracks can move without queuing and waiting to pass each other. Secondly, number 6 Winds, which is a sub-level shaft, which basically enables us to go a bit deeper from below the current infrastructure of 750 meters. And thirdly, and most importantly, a brand new shaft, which goes from surface down to 1,000, essentially 1.1 kilometers underground. So our current infrastructure is constrained to 750, and it was economically made sense to just essentially build a brand new mine underneath the current mine, and I'll show you that graphically now. So this is the ore body, a cross-section of the mine. So here we're looking, this is about 3 kilometers from end to end, and about 1 kilometer in depth. There's essentially 4 sections of gold-bearing ore. There's blanket, all these grey areas are mined out, and the coloured areas are your measured, indicated, and inferred resources. So there's blanket, AR South and AR Main, which are that's where the lion's share of our future production comes from, and then Eroica and Lima. So this is what it took us 100 years to mine out these sections here, albeit at much lower production rates. That's 750 meters. That's where our infrastructure is currently constrained to, or was constrained to pre the investment. That is our number 4 shaft, which is our main production shaft at the moment. So you can see we're coming down here and tracking along. Remember I said this is, that's probably about a 2-kilometer journey. So logistically, because the shaft was there, you end up, the guys spend a lot of time traveling to get to the face. These are, so the difference there, that is the gold I'm talking about, which we don't yet have in measured, indicated, and inferred resources. We've drilled them. We know that the mineralization continues, but 1, for geological prudence purposes, and 2, from a regulatory point of view, we can't report that as gold resources. So we know the rock continues down at that depth. These type of ore bodies tend to go very, very deep into the earth. Our neighbors are at 1.5 kilometers. They're 3 kilometers away from us, and they're at 1.5 kilometers depth. We're at 750 meters. And that's where the gold came from, the geologists tell us that that's originally where the gold came from. That's number 6 Winds, which basically allows us just to get a little bit deeper in here. And that is the new central shaft. Now, just the reason it's, it's a 6-meter diameter shaft. It's much larger than the existing shaft. And that will set us up to mine and extract from depth below for probably the next 20 years, we anticipate. Important to note that you're coming down right where the gold is. So right now, our men come down here, they then move all the way across here, and they start working and then transport the ore all the way back and send it up there. This shaft moves much, much faster and transports much more people, and it comes down right where the money makers are. That's what it looks like. So that's before we dug a hole. That little mark there is the center of this hole now. That's what it looks like today. We're currently at a depth of 300 meters, and we're going at about 3 meters a day. So we'll be on track to be in production for this by 2018. From a production perspective, this is our historic production. We're on target for 50,000 ounces this year, 65 next year, ramping up to 80. And that's about 60% of our cost of this mine are fixed. My salary, interest, all the overheads. We have quite a large fixed component in this business. So that's likely to bring our all-in sustaining cost down to somewhere between $700 and $800 an ounce as we go forward. So what does that mean from an earnings perspective? This is now, we're doubling our production. We're going to be producing 80,000 ounces of gold at EBITDA margin of somewhere between $500 and $600 an ounce, depending on what the gold price is. So there's a cash, the all-in sustaining costs of somewhere between $700 and $800. That will generate us in the neighborhood of between $40 and $50 million of cash a year, which after minority interests and taxes is going to get us from an earnings perspective. And these are not our numbers. These come from Edison. So it is paid for research. We do pay for this, but we think they understand our business pretty well, and we've looked at their numbers, and we feel comfortable at least circulating them like this. But that gives us earnings per share of somewhere between 40 and 50 cents a share, which at today's price puts us on a forward PE 3 years out of somewhere between 3 and 4 times. So we've had a good run, and you still get a 3.5% dividend while you wait for that. But we do think there's still some more place to go. This is our CapEx profile. The only thing I really want to say, there's peak CapEx is this year. So we have, over the past few years, been investing in this project. Our cash has declined as we've had to fund this investment during a very, very difficult time for the gold price. We've genuinely, we believe, invested against the tide, both in terms of Zimbabwe as a political destination, but two, in probably one of the most difficult gold markets, certainly in my memory. And this CapEx is declining quite comfortably. Next year, we're planning to spend $15 million. If at our production target of 65,000 ounces, this mine's going to kick off to us as a minority, our interest plus the repayment of the loans I mentioned earlier, $20 million next year and probably $30 million the year after that. So we can comfortably afford this and pay the dividend and hopefully grow the money in the till. I mentioned we pay a dividend. We used to be right on the left there, but the share price has run away and so the yield has dropped. We're okay to be in the middle. I will just flag the payout ratio, which is, this dividend is 4 times covered by earnings. It only costs us just under $3 million a year. So in terms of the cash flows we're generating going forward, you can do the maths for yourself, but we're going to be in a position where cash balance-wise, we're going to have to figure out what to do with the money. One of those options is to pay it back to shareholders, obviously, if we can't find a suitable investment destination for it. I think in the interest of time, I'm going to go through this fairly quickly. In summary, this is really not a stretch target. We've got the money to do it. We've got the people to build this. Our chief operations officer comes from Goldfields in South Africa. He's built shafts below a kilometer before. So we're very comfortable that the plan is on track and we're operating. It's funded, as I said. The returns are very, very good. I don't have the IRR to hand, but the whole project is costing us $45 million in capital, and it's going to generate that fairly quickly. And it's a very mature environment. We've got good people running it. You come to our mine, it's not like Tanzania or Mali where you have loads of Australians and Canadian expats. It's all run by local black Zimbabweans. The education system is excellent. These people really know what they're doing. Our numbers do speak for themselves. So in summary, I think I wrote that headline when we were still the highest yielding gold stock. We're not anymore, but we do have a very good dividend yield. And it's from a dividend cover perspective, we can afford it very, very comfortably, and we could probably double that dividend without breaking sweat. I mean, we're not at the moment while we're busy planning it, but we're busy building and investing, but the dividend's very comfortably covered. We have low-cost operations. We would back ourselves to survive virtually any conceivable future gold price environment. Personally, I think the gold market bottomed in December last year, but we're okay even at $1,000 with our expansion plans. We'll be all right. We have growth potential. Obviously, I mentioned we're doubling production. I've talked through that. We're going to have to figure out what to do with this money. We're acutely aware that our industry has a terrible reputation for spending the profits of a good mine on a bad mine. We don't want to be those guys. So we're we're very careful to not be stupid, to put it bluntly, which the industry has blown its brains out before. So, and we have an excellent management team. Our chief executive, Curtis, he was born and grew up in Zimbabwe, has very good relations with the government, and those things are important in terms of making sure we can import and export, get our logistically manage the capital project, and so yeah, we have good people running the show, and we think the numbers are speaking for themselves. That's all I've got. I don't know if there's any questions.
Time for questions, anybody? Gentleman just here.
Hello.
Hey.
At 92, you must be planning for a post-Mugabe situation. What's your feeling on how the political landscape will develop once he departs the scene?
The short answer is we think it gets better, not worse. Again, it's difficult for us to speculate on the political developments, except to say that we think the structures within ZANU-PF will bring forward a new leader to replace Mugabe. I'm not sure how much more we can comment, except to say that I think it's likely to get better, not worse, but there's probably going to be some bumps in the road along the way.
Likely to be peaceful or violent, the transition?
No, I think one of the criticisms I'd have of Zimbabwean people is they're almost too peaceful. They have been too accepting of the damage that's been done to their country by some of the policies of this government. You see it even now. They're wonderfully friendly, peaceful people, but there's not violence and rioting in the streets. So I don't think so. But it's one of the things we can't control, unfortunately, and we have a view, but it's not worth any more than anyone else's view of the country. All I can say is it's a fine place to operate a mine. The people know what they're doing. Our numbers speak for themselves. So I wish I could be more helpful. But
no, just when you said you had piles of money, you wouldn't think of diversifying out of the country then to mitigate that risk?
Sorry?
I said with the extra money you have to invest, you wouldn't think of diversifying out of that country to mitigate that risk?
Yes, we are looking at assets, obviously. We're in a position, we have no debt, we've got 10 million in the bank, and we are looking at what to do with that money. The default position we measure every investment against is, what if we just divvy this all out to shareholders? And that would give us a dividend yield of what? And when we've done the maths, and the default position is whatever we invest in, we'd have to do better than that. We like Zimbabwe geologically. We think it's underexplored. The assets are cheap. And we know how to operate there. We have a genuine competitive advantage in operating in Zimbabwe. I think we can say that without fear of contradiction. So we would not. I think we would be led first and foremost by the quality of the asset we wanted to invest in. If it was outside Zimbabwe and it was a good quality investment, we would definitely look at it, absolutely. But we have looked at very carefully things in Zimbabwe, and we continue to do so.
Gentleman right at the far side.
It looked like your earnings per share in 2018 actually started to drop off. So if the capex is falling and your production is rising, why is that?
I think that, if I'm not mistaken, is Edison's gold price assumption. The important thing to bear in mind is that we will have a large lump in cash flow as the $30 million of loan that we've made to our indigenous partners is repaid to us, and those loans carry interest. That doesn't happen past 2018, so I think that's a gold price assumption from Edison. I can check that, but we will essentially reap about $30 million plus interest of additional cash flow. Long term, past about 2021, we'll get 49% of the cash flow, and our indigenous partners get 51%. So the cash generation will decline as we go over this hump. Yeah, you're correct. But we'll have doubled production by then, so hopefully it comes out in the wash.
Gentleman just down here.
If I could ask, how are relations with the local community, and what's your health and safety record like?
Our health and safety, our last fatality on the mine was 2 years ago, which was a heart attack in office, where the guy was climbing a ladder, had a heart attack, and fell down the ladder and died. So a fatality is a fatality. You know, it's reported as such, but it wasn't unsafe conditions that we were operating in. Before that, I think the last one was back before we owned the mine. So a health and safety record is very good. We are blessed with very solid rock, very competent rock. There's no roof support in the whole mine. It's tombstone granite, basically. Yeah, that's all I can say on health and safety. The community own 10% of the business, so they have quite a bit of skin in the game, and the workers own 10% of the business. So there's a dual, a dual benefit. Our mine manager's been there 35 years. He's a very important man in the local town. We have good relations with the community. Yeah, no issues.
Thank you for your question, and Maurice, thank you very much indeed. Thank you.
Okay, thank you.